Hello everyone, welcome to my channel. Today I want to share with you some main strategies for trading in US stocks. Whether you are a veteran or a new stock friend, you can learn a lot today. Remember to click the subscribe button first to keep up with our program. Okay, so some strategies for trading in US stocks. I divide them into two categories. The first type are chart-based analysis strategies. What is a chart type? Obviously, it is technical analysis, which is analyzing through looking at charts. And within this category, I'll divide it into three categories. The first type, intraday trading. What is intraday trading? Intraday trading, it means doing a transaction on the same day. T+0 trading. You can both buy and sell through small cycles, such as a 5-minute cycle chart. In this, you can both buy and sell. If you choose to go long, you buy low and sell high. Then you need to find the support level to enter, and then exit at the high pressure level. For example, this 10 minutes one, this represents the fluctuation of a day, which represents the daily fluctuation. If you enter here and exit at this position, you can make a small band. You can earn a profit for the day. You can also short first and then long, which is short selling. This is intraday trading. The advantage is obvious. That is, your risk is controllable, and overnight risks are controllable. The trading frequency is also relatively high, and the profit will be greater. This is one. The second trading mode is band trading. It means holding for several days to several weeks. It's not like buying and selling on the same day. If you want to catch a band, let's take a look at the stock of Meta. The stock of Meta, its overall trend, it's a trend of shock and rise. If you, at the starting point of a band, and enter the market, then you can get a good entry point. Look at this band, right? From this wave to here, to this wave, and then rise from here, and then fall back from here. This position, it is a relatively large band interval. If you enter at this low level, you enter at this position and then exit from here, the profit will be quite good. The holding time will be longer. Not intraday trading, but overnight. This is the second type. The third is to hold for a long time. The core logic is that you buy and don't sell. Basically, you need to hold it for several years. If you want to buy this kind of stock, you need to base on the company's long-term fundamentals. It must be relatively good, which is similar to value investing. These companies are safe for long-term investment. In the long run, the stock price with value will rise. You can ignore short-term fluctuations and earn compound interest from the company's growth. For these three types, you can only grasp them from the graph. For long-term investment, you must find a relatively low point in price, and then you can do long-term investment, right? For example, the current position of Meta at such a high level, if you want to do long-term investment, even if it goes up, the short-term increase will be relatively large. We don't know how much it will rise in the long term, how much it will rise in the future. In general, try to find a relatively low position and enter at a relatively low point, right? If you do long-term investment, it's relatively safe. The upside is large. In general, it can basically not fall further. There is a large upside. This is suitable for long-term investment, and the company has growth potential. This is the third type. The second is value investing and fundamental analysis-based investments. The fundamental strategy, there are mainly three. One is value investing. What is value investing? In general, it is two lows and one high. What is low? Low price earnings ratio. First, price to book ratio. Price earnings ratio is the stock price divided by earnings per share. The lower, the better. Or price earnings ratio. If it's lower than the industry average or historical average, it is relatively safe. The same goes for price to book ratio. Price to book ratio is the stock price divided by net assets. For example, banks, mines, financial and cyclical companies. You can look at their price to book ratio. Those with high dividend yields have dividends and high dividend yield. This is value investing. If the stock price is lower than its value, you can hold it for a long time. It will return to the value. Companies like banks and mining, cyclical companies are better. These are the ones they hold, which is value investing. A strategy for long-term investment. Because value investing, it is a comparison between price and value. If the price is high, the value will be overestimated, right? If the price is overestimated, it will fall back. In the case of a lower price, and the value is underestimated, it will return and it will rise. This is the strategy. This is the first strategy. The second strategy is growth investing. What is growth investing? It is a company with rapid growth, and the valuation will be relatively high. Price-earnings ratio and price-to-book ratio will be high. Even if the current valuation is high, but its future growth will be faster. Its valuation will soon come down because the valuation, the price-to-earnings ratio, is the price divided by the earnings per share. Earnings per share. If it continues to grow rapidly, high growth rates, its price-earnings ratio will quickly decrease. So don't look at the present, you should look to the future. This is a high-growth investment for companies with high growth, are suitable for technology companies. And also in the pharmaceutical industry and innovative drug companies, this is a growth investment. For these stocks exist in high growth industries, such as semiconductors and other industries, and innovative drug industry. These industries are all high growth industries. In terms of its index, you can see that there are overall large fluctuations, but the trend is also upward. For these companies, they have a relatively high growth rate, so they can be a relatively high price-earnings ratio valuation. That's the case. So this is the second type of investment, is to look at the future. Simply put, basically, you should not lose money. It's better to have profits now and not lose money, because if a company continues to lose money, they are prone to greater risks. This is the second type, is growth investing. The third type is some event-driven strategies. What is an event-driven strategy? It means using some short-term news stimulation to capture short-term stock price fluctuations when the financial report is released, such as mergers and acquisitions or shareholder increases, to make a layout in advance, especially the one that just ended. There are 4 opportunities for current financial reports because there are 4 quarters. At the end of each quarter, the financial reports will be released: first quarterly report, second quarterly report, and third quarterly report. The just released one is the second quarter report. For the second quarterly report, some companies, their performance has grown rapidly. After the financial report is released, their stock prices will rise sharply. Like Meta, when Meta announced its stock price was falling, before the report was released, the stock price fell. Before that, institutions had made sufficient predictions. The prediction was that it would grow rapidly and the performance would greatly exceed expectations. So before the announcement, if you are quite sure that its performance would greatly exceed expectations, then you can buy in advance. After buying, and then it opened high after the announcement and rose by 12%. This is to take advantage of this event-driven every year during the earnings season and some share repurchases or mergers and acquisitions news. You can also make preparations in advance to do something, and including some big events such as tariffs. Before the tariff was announced in February, Trump had already given a heads up saying that tariffs would be imposed. After you know this news, you can short it, right? After the news was announced, you could short it. When it was officially announced in April, it was announced on April 2nd. We can see it was on the 12th, right? After the announcement, it fell sharply on April 3rd. From February to this period, it was generally falling. Should be shorted to capture the gains in this period. The profit from short selling, then wait for the news to come out, then close the position and leave. This is market driven. For example, if tariffs are later cancelled, Trump and later announced to suspend or delay tariffs in the same way when it was announced here, it seems that on this day, these are all news-driven events. It rose sharply that day, right? The market rose sharply that day, and then, so if you know this news, you can enter the market to buy it. Yes, including when the negotiation agreement was reached with China, when it was negotiated here, it was agreed, and then it rose sharply. These are all news stimuli, event-driven events. So these are some opportunities that we can seize at mergers and acquisitions. If you know in advance, you can also make a layout. This is the fundamental strategy. Well, today I will tell you the main trading strategies for investing in US stocks. Whether you are a veteran or a novice, I think you should finally form your own system. You need to have your own strategy. Only what suits you is the best. There is no best strategy. Only what suits you is the best. If your personality is suitable for graph analysis and you don't want to do fundamental analysis, if you look at the charts, you can choose intraday band trading or longer-term investment or some long-term investment. If you want to do some value-based fundamental analysis, you can choose companies for in-depth research and see some more certain opportunities. You can choose these strategies. If you can gain something today, then you can click on follow and subscribe. We will continue to update our channel. You will get more knowledge and dry goods.